In this video, we're going to look at Tesla. And what I do in my videos is I try to figure out the actual stock price for a company. And I use prior financial information to do that. So let's get started with the model. This company has a $273 billion market cap. That's the value of the company. If you take shares outstanding times stock price, that's the market cap. They're currently trading at $14.90. And now we need the free cash flows. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today. And that's exactly what I'm doing in the video here. So we're going to take 4 years of free cash flows. And then we're going to pull the net income, and that's the profit and loss. And that's on the income statement. And we also need the revenue, which are the sales for each year. And as you can see, it's been growing pretty rapidly. So you want to take a look at the numbers to make sure they look okay. Now, you can't really get a value for a company with so many negatives. So what I did was I built a fifth discounted cash flow model to try to value companies that have negative free cash flow and negative net income. And I'm going to show you more details of that model when I get to it later. So let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. So the interest they pay on their debt is $685 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to the liability section. And current debt of $1.8 billion, that's debt due within 12 months. Long-term debt of $11 billion, that's debt due after 12 months. So they don't pay any taxes because they operate at a loss. So the cost of debt is 5.1%, which is the interest rate. Let's get the cost of equity. We need the beta for that, and that's how volatile the stock is relative to the market. And they have a beta of 1.2. So the stock moves a little more than the market. And let's get their current assets. We need this for the current ratio calculation later. Current assets are mainly cash, accounts receivables, and inventory. And that's $12 billion. And let's get their current liabilities. These are debts and payables that the company owes within the next 12 months. And that's $11 billion. And let's get their equity. That's assets minus liabilities. And we need the equity because in the ROE calculation, the formula is net income over equity. Also, in the price to book value formula, the formula is price of stock over equity per share. Let's get their EBIT, earnings before interest and taxes. And that's called operating income on the income statement. And that's $80 million. And we need this number for the interest coverage ratio calculation later. So the weight of debt is 67%, and the cost of debt is 5.1%. The weight of equity is 33%, and the cost of equity is 11.5%. And the weighted average cost of capital is 7.2%. And that's a combination of the cost of debt and cost of equity. 7.2% is the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $99 billion. We divide that by 183 million shares, and we get an intrinsic calculated stock price of $538. They're trading at $14.90, so they're trading at 177% premium. So to sell according to the model. Let's see what Simply Wall Street values them at. They're at 803, so they're a little higher, but they're also saying it's overvalued the stock. So it's really difficult to value a stock that doesn't report positive numbers. I recently created another discounted cash flow model to try to value a company that reports negative numbers. The way I estimated the next 4 years of free cash flow, I just added a growth factor to the 2019 free cash flow. In Tesla's case, they did have positive free cash flow in 2019 for the first time. So the projection for the next 4 years is positive. But if they had negative in 2019, like they did in prior years, it would have been a negative estimation for the next 4 years. So the real change to the model was estimating the following 30 years of free cash flow. So from 2019 to 2016, they grew their cash flows $2.5 billion, which is an average of $633 million a year for the 4 years. So I took that average growth and extended it out 30 years. So for year 2024, I assumed that was their free cash flows. So regardless of what they did in the past, they are operating at a profit. And I extended that $633 million free cash flow growth per year for 29 years. And then I did a terminal value, which is all years past year 2048. The more companies I look at, the better this model will get. Just like my original model when I started the channel, it has gotten a lot better the more videos I've done. Let's look at the financial ratios. I have negative PE because I have negative earnings, and earnings are just net income. What some people do is they look at price to sales ratio for companies that have negative earnings, because you can't have negative price of sales, because the way you calculate the price of sales is price of stock over revenue per share, and you can't have negative revenue. They're not even doing that well in price to sales ratio. I like to see under 2.5. They have a terrible price to book ratio of 41. That's price to stock over book value per share. They're doing okay in current ratio, which is surprising. They can cover their current liabilities. They have a negative ROE because ROE is income over equity, and they have negative income. They can only cover about 1/10 of their interest payment. So that's not a good sign. That just means they're going to have to borrow more money. And they're 67% debt. The best way to look at ratios is to compare them to similar companies. I've done a video on Ford, and in terms of PE, PS, PB, current ratio, and ROE, Ford wins. Tesla has less debt and a much bigger market cap. So let me know what you think of the video. Do you invest in Tesla? Thanks for watching.